Welcome to yet another exciting episode of MoneyWise, where we bring educational content to our audience. Today, we dive into one of the most important topics in our economy: interest rates, inflation, and financial investments. These three major forces shape the financial landscape, and today, we'll break down how they interact and why they matter. So let's start with the basics. Interest rates are the cost of borrowing money, right? They're set by central banks and have a significant impact on how individuals and businesses spend and invest. Could you explain how these interest rates influence the economy?
Thanks for providing the opportunity to discuss the fundamentals of this topic. Basically, interest rates set the cost for borrowing money. When central banks raise interest rates, borrowing becomes more expensive, leading to reduced spending and investments. On the other hand, lower interest rates make borrowing cheaper, which encourages spending and investments, stimulating economic activity.
That's a clear explanation. And how do these interest rates affect the debt that individuals or businesses hold?
Absolutely. When interest rates go up, people with loans or debts like mortgages will see their repayments increase because the interest on those loans is more expensive. For example, if you have a mortgage with a fixed interest rate of 3% and the rate increases to 5%, your monthly payments will rise and it will cost you more over time to pay off the loan. Conversely, when interest rates are lower, it's easier to manage debt because the repayments are smaller. For instance, if the mortgage rate drops from 5% to 3%, your monthly payments would decrease, making it easier to pay off your debt.
That's a fantastic explanation. I really appreciate the example you shared. It breaks down the concept in such a clear and relatable way for our audience. It's often the real-world examples that help us truly understand the impact of these economic forces. Now, let's talk about inflation. How does inflation tie into interest rates and the broader economy?
Great question. Inflation is the rate at which the prices of goods and services increase over time. Apparently, when inflation rises, it means that the value of money decreases, and everyday items like groceries or gas become more expensive. For instance, if the price of a loaf of bread increases 10% over a year, that's inflation in action. Your dollar doesn't stretch as far as it did before. So to control inflation, central banks often adjust interest rates. If inflation is rising too quickly, central banks might raise interest rates to slow down spending and reduce the pressure on prices. However, on the flip side, if inflation is too low and the economy is slowing down, they may lower interest rates to encourage people to spend and invest, helping to boost economic activity.
That makes a lot of sense. It's fascinating how inflation impacts our daily lives and how central banks use interest rates to keep everything in balance. Your example about the loaf of bread really puts it into perspective. It's a valuable reminder that even small changes in inflation can affect what we pay for everyday goods and services. Now, let's bring this all back to investments. With all these fluctuations in interest rates and inflation, how do they actually affect things like stocks or bonds? And how should investors adjust their strategies to navigate these changes?
Great follow-up. So when interest rates are low, investments like stocks or real estate often become more appealing because the returns on these can be much higher compared to what you'd get from a savings account or bonds. It's like a no-brainer for many investors looking for better returns. But when interest rates start to rise, the story changes. Bonds, which are typically safer, begin to look more attractive because they offer more stability and decent returns. As a result, stocks might not see as much growth since investors tend to shift toward the safer options. Essentially, investors need to stay flexible, adjusting their strategies as the economic environment shifts in order to maximize their returns while managing risk.
That's really insightful. It's clear how important it is for investors to stay flexible and adjust to these changes. Now, when it comes to inflation, how does that play into investment returns? Should investors really be factoring in inflation when they're making decisions about where to put their money?
Absolutely. It's really important to think about investment returns in terms of inflation. As an example, let's say an investment is giving you a 5% return, but inflation is sitting at 3%. That means your real return, the actual growth of your money, would only be 2%. So even though the nominal return seems decent, inflation is quietly eating away at your purchasing power. That's why it's so crucial to consider inflation when evaluating your investment strategy. It helps you see the true picture of how well your money's really growing.
That's a great point. To really put it into perspective, let's say someone is getting a 7% return on their stock investments, but inflation is sitting at 3%. That means their real return is actually only about 4%. So it's not just about what you see on paper, it's about how inflation affects the actual value of your returns. If the real return is positive, then it's a solid investment. But if inflation is eating away more than what you're earning, then your money isn't really growing in value. And that could be a red flag for your investment strategy.
Exactly. It's so important to factor in inflation when evaluating your investments. Even if you're seeing positive returns, if inflation is chipping away at those returns, you're not really moving forward in terms of purchasing power. It's like running a race where you're not really getting any closer to the finish line. So, keeping a close watch on interest rates, inflation, and adjusting your strategy accordingly is really crucial to maintaining long-term financial health and ensuring your money is truly working for you.
That's some incredibly valuable insight. Thank you for breaking it all down so clearly. It really helps to understand how these crucial topics are all interconnected. It's clear now that grasping the relationship between interest rates, inflation, and investments can truly make a huge impact on how we approach our financial decisions. And it's also a great reminder of just how important financial literacy really is in navigating our financial futures.
It was truly my pleasure. I'm really glad I had the chance to share these insights today. Understanding these concepts can make a real difference in how we manage our finances, and I'm happy to have been a part of that conversation.
A big thank you to all our listeners for tuning in. Just a quick reminder that this content is purely educational and doesn't offer financial advice, but we hope it provided valuable insights to help you navigate today's economy. We love to hear your thoughts on this topic. How do you stay informed about the latest economic trends? Don't forget to like, share, and subscribe to our channel for more insightful discussions. Until next time, stay curious, stay informed, and we'll be back soon with another exciting episode. Signing off.